Welcome to Market Call. I'm Marella Fernandez. Chris Thom on the show today with us. He's CEO and Portfolio Manager at Moat Financial. He's taking your questions today on North American equities and on options. Call us toll free, 1-855-326-6266. You can email us as well, marketcall@bnnbloomberg.ca. Chris, thanks for coming in.
Yeah, thanks for having me.
Let's talk a little bit about GDP numbers off the top, if you don't mind, because we had some growth in June. We kind of squeezed out just a little bit of growth. And we also heard from the Bank of Canada team yesterday, from the governor specifically. From those remarks and from the numbers we have today, how would you say we're doing or managing within that tariff spectrum?
I mean, I think it's working out better than people thought as the tariffs were sort of being introduced earlier in the year. But I think, it's going to be a bit of a tough road as time goes on. A lot of what we do, a lot of what we sell is under pressure and likely to remain that way for some time. I mean, I think tomorrow is the deadline, and I don't think we're going to have a new deal. So, I think get used to it.
Yeah, you don't think we're going to come up with a deal. You think it's going to be kicked down the road?
I don't know if it's going to be kicked down the road as far as a deadline, but I think as far as, tomorrow's the expiry date for not having these tariffs. So I think Trump has been pretty adamant that, there will be no extension. So, he seems like he's taking a pretty tough stand on Canada here.
Okay, so I want to know whether you think that will add a new layer of uncertainty, and do you think we'll see the markets react to that?
Well, I think there's definitely uncertainty out there, which is, it's surprising. You look at where markets are, they're at all-time highs in Canada and in the U.S. So even with all this uncertainty, the market seems to be treating it favorably. But I think, where we look at the market, and a lot of this is from an options perspective, so we actually kind of like a bit of that uncertainty. That keeps option prices higher. It keeps implied volatilities higher. And from our perspective, the uncertainty is a good thing.
Why do you think we're seeing the enthusiasm, the optimism in the markets that we have seen? Because they took that dip in April, but they've been bouncing back ever since.
I couldn't tell you. I mean, we've maintained pretty cautious optimism. We think that businesses, they adapt with whatever they are seeing in the current marketplace. So, whatever the market throws at them, they have to deal with it. That's one of the beauties of investing in businesses. But yeah, I think investors have been a little bit more optimistic than I would have thought. So, we're out there still trying to find value and, maintaining positions where we don't think things have gotten too extended.
Got it. Okay, we're going to take a quick break. We'll line up some phone calls and some emails for Chris Thom of Moat Financial. Here's how to reach us. We're back in a moment. Welcome back to Market Call. Thanks for joining us today. Chris is with us. He's going to answer questions. The first one comes in an email from Jerry. He says, I own AbbVie and I have had a good run. Should I trim or leave it? About 6% of my portfolio at this time. What's your forward look on AbbVie?
Yeah, Jerry, so obviously the stock has done well. It seems like it has grown to probably a little bit bigger of a piece of your portfolio than you're comfortable with. So from our perspective, I don't have too much of an opinion on this particular stock itself, but when I take a look at the options on it, if you are wanting to trim, a really great way to do that is to sell a covered call. So you are selling somebody the right to buy that stock from you at a higher price. So right now with the shares around 194, you can sell the September 200 call for about $4.50. So someone's going to give you $4.50 just for the right to buy that stock $6 higher. So it's a way that you could do that against a piece of your portfolio or a piece of the position and trim it that way. And if the stock doesn't go up, then you'll just hang on to your stock.
Okay, we hope that helps Jerry out as we move on to the phone lines. David is holding on the line today from Ottawa with his question. Hi, David.
Yes, good afternoon. Excuse me. Thank you for taking my call. My question is not really on Bank of Montreal, but it's an option strategy. I would like your opinion on selling a call that's in the money, and that call has a stock that's going to go ex-dividend. So after ex-dividend, of course, the share price is going to go down. And so that call option that you sold should go down in price because the share price went down. With that, and then later you would buy back the call and make a profit there. Is that a good idea, or is that some kind of strategy that you would entertain? Thank you very much, and have a great day.
Okay, thank you for the question.
Yeah, so if you own BMO and you are comfortable selling it at this level, you think it's not going to go up much from here or even go down a little bit, then yeah, that seems like a fine strategy. For us, we typically like to leave a little bit of upside between where the stock is trading and where we will sell that call. Now, if you look at the Canadian banks, these are pretty stable businesses. BMO is obviously a great company, a real leader in the ETF space. They obviously make a lot of money there as well. So the volatility is not as high, so the option premiums are not really high. So selling something closer to the money or even in the money, that can make sense. You're really kind of riding a fine line there that, exactly what you expect is going to happen over a short period with this stock will happen. And that's pretty difficult to predict. So, I think it's okay, but I'd leave a little bit of upside on that stock.
Got it. Okay, let's go to the phone lines. Again, we have John on the line from London today with a question. Hi, John.
Thank you, Marilla. Hello, Chris. Chris, I've been trying to analyze reports on Meg 7 over the past week or two. And I've broken it down into a regression analysis of, number one, did they beat earnings? Number two, did they beat revenue? Number three, did they raise guidance? Number four, did they agree to increasing AI spending? So you look at the results, Meta and Microsoft are big winners. Not so much Apple. Google did well for a while, but it's down today. And that leaves Amazon, who did well. How do you interpret this? I'm trying to predict stock price. I'm probably going to keep all Meg 7 for a long time, but I'd like to add on days like Monday, where look what Meta did and look what Microsoft did. Thanks very much for your help.
Okay, thank you for the question. That is a big question.
Yeah.
First of all, do you agree with the metrics that he's chosen to isolate and look to?
I think those are all good metrics. A lot of times for us, when we're looking at stocks, we want companies that are trading at attractive valuations. PE is not the be-all and end-all, but it's definitely where we start when we're analyzing these companies. We've got the benefit of hindsight. I could tell you that Meta and Microsoft, their numbers were pretty good this quarter, and their stocks are doing well today. So, I think if you're going to be owning all of them and you're wanting to buy more, then I would be buying the ones that are trading at the cheaper valuations and look for them to grow into the higher valuations like some of the other names.
Besides just the price of the stock, are there one or two that you prefer for other reasons?
You look at Amazon, obviously that's a great business. It's growing. They've got, the AWS, that's a huge piece of their business, but they're also direct to consumer. And so in a time where, people are seeing inflation, that business just continues to grow. Amazon and Costco, obviously that's not a Mag 7, but that's where more people are going to buy things. So I think it's not trading at a real stretched valuation. So that's a place that I'd probably look.
Got it. Okay, let's go back to the phones. Mike's on the line. He is in Toronto. Hi, Mike.
Hi there, guys. Pardon my layman's terms here, but I'm getting excited for tax loss selling season, and I'm thinking, is it maybe time to consider opening a call option on something like BC or Enbridge, and also U.S. versus Canadian? Thanks so much.
Okay, thank you for the question. BCE, we will remind people, is the parent company of this channel under the Bell Media brand. Stock has been hovering, I have to check, but it's been hovering around $30. And so is he right to sort of look at it this way?
Yeah, so I didn't fully understand what your plan was, if it's to try to sell these by selling a covered call and then getting called away as part of a tax loss strategy. Obviously, I'm not an accountant, so I can't be here giving tax advice, but one thing that some people will do is sell a stock and then sell a in-the-money put or a cash-covered put to maintain some exposure to that stock after triggering that gain. You just need to make sure that you're not acquiring the stock within 30 days, or else the tax loss won't count. So, Yeah, if that, and then the difference between Canada and the U.S. on a tax perspective, it should, again, not an accountant, but these should always be treated as capital gains if you're selling options, whether it's in Canada or the U.S. It would just be a bit of a difference in the currency when it comes to calculating what those gains and losses are.
Okay, I do want to ask you a follow-up because I'm wondering if when you're looking at a strategy and you've had a stock that you think has either stalled or it has dropped and you've lost money on it, what is the best strategy or approach to trying to recover some of that value?
So, I mean, there is some option strategies that you can use. There might be a bit of a longer conversation. We've actually got some webinars that we've recorded. You can learn a bit more detail about this on our website. But something called a 1-by-2 call spread. So basically, if you own a stock and it goes up, you're making money at 1x. Right? Stock goes up $1, you make $1. But you can do what's called a 1-by-2 call spread, where you buy a call option as well. So you're long the stock, and then you buy a call as well, and then sell 2 calls at a higher strike. A lot of times what you can do is pay for that call that you're buying by selling those other 2. So your net cash outlay can be 0. But what that does is between that window of the call that you bought and the 2 that you sold, you actually make money at 2 to 1. Above that level, you stop making money. So there is a window that it works, but that will potentially get you back to even quicker. And then it maintains the same downside. So the stock keeps going down. You make you didn't pay any money to put the trade on, and then you're at 1 to 1 on the downside. So.
Got it. Okay, we are going to take a quick break. We're lining up more phone calls and emails for Chris Thom of Moat Financial. Here's how to reach us. Welcome back to Market Call. Let's go right to the phone lines. Michael has been holding online. He is on the line in Vancouver. Hi, Michael.
Hi, I had a quick question about Microsoft, please. I'm just wondering, I've invested myself, but bricks and mortar are great, but the illusion of the Internet's kind of worn off. Is it still a safe investment for myself and others? Thank you.
I missed the second part of his question.
Yeah, sorry, I missed that. I mean, if the question is Microsoft a good investment, I think long term it definitely is. I mean, you can't say anything other than it's a good company and has continued to grow and has adapted through the markets, and we all use it every day, and we can't really get away from it, even if we tried. So, it is trading about 41 times earnings. So, it's an expensive stock. So, if you've owned it for a while and you've done well with it, it may be something that you look to diversify away from a little bit. But so far, over the last 30 years, diversifying away from Microsoft has been a bad idea. So, with the next 30 hold, I'm not sure.
Yeah, he seemed to imply that sort of the online experience is falling off, but obviously with AI, I think we're ramping up instead of falling off. So definitely something you would consider holding on to as opposed to getting rid of. Okay, let's go back to the phone lines. I think we have Kathy. Is it Kathy on the line in Toronto?
Yeah, hi, it's Karthi. Yes.
Karthi, thank you.
Okay, thanks for so much of insights from your show. It really helps me investing. So I have a question on Adobe. With AI and tech, where is Adobe right now? But, it's forever in the red over 3 months or 1 year. So I just like to see your take on whether it's a good buy now or what's your price target on that.
Okay, so Adobe, I've had different analysts talk about Adobe, and some say, it is bound to come back because some see them as competing with AI and not necessarily bringing the products that will sort of be better than AI. But others argue their product is meant for the specialists, the experts in the creative fields, and that AI can't really mimic that experience. Where do you land on Adobe?
I mean, again, this is something that, I don't think that they are a buggy whip producer type thing. I think they've got a lot of different products, and they're in our everyday activities. And you even see, if you're on ChatGPT and it does some work for you, it asks you, do you want me to put this in a PDF for you? So, it's definitely ingrained in our everyday, and I think that's likely to continue. If you own it and it's been a bit of a painful one, that 1-by-2 call spread that we talked about a bit earlier, that's something that you could take a look at, or just looking to generate some call premium and sell some upside calls. On a stock that has been beaten up like this, the option prices are typically high. So if you want to start extracting some premium from that, there's definitely an opportunity to do that.
Got it. Okay, Carthy, I hope that helps you out. Let's go to Bernie from Toronto with a question. Hi, Bernie.
Hi, how are you? Good afternoon. I have a short question on Whitecap Resources. Is it a good time to enter the market with this? I mean, it's yielding a nice dividend, about 5.7%. So I was wondering, is it a good time? And also, is it part of your holdings? Thank you.
Okay, so we'll talk about Whitecap, which is had a deal with Varen and actually got hit a little bit after that. Varen went up, Whitecap went down, but it has since recovered. Do you own Whitecap? What's your take on it?
So it's something that we don't really own widely. I mean, especially now that they are entering into this deal, we'll be waiting to see what that company looks like on the other side. So don't really have the strongest opinion here. I mean, it is something that we do get questions about, and when we take a look at it from an options perspective, when you see companies going into deals like this, a lot of times the option premium can kind of disappear. For this one, if you don't own it, you could look to buy it at around $10 out to October and sell that $10 put cash covered, so 54 cents below where the stock is now, and collect about 20 cents. So you're going to generate 2%. If the stock goes down, then you'll be buying it, and if the stock stays here or goes higher, then you make 2% over 2 and a bit months. So that's the way I would look at it here. But no, we don't own it.
Got it. Okay, let's go back to the phone lines. We have Alfred on the line. He's calling from Mountain View, California, I believe. Hi, Alfred.
Yeah, hi. Your outlook on Berkshire Hathaway, please, 1 year, 3 year, 5 year outlook. Thank you.
Okay, thank you for that question. I'm not sure how far out you can look for Berkshire Hathaway, but what is your take?
We like it. I mean, obviously the stock had done very well earlier in the year when they had raised all that cash, and the market started going down. People who held cash were the smartest people in the room. So, we do like it. We think obviously Warren Buffett, he's stepping aside, and so his leadership won't be there. But he's built a pretty deep bench at the company. So, if you just take a look at what they own, if they never did another deal ever again, that company has a lot of legacy brands that are really great producers. I mean, it's an interesting concept where they don't pay a distribution, but yet they own a bunch of really high cash flowing businesses that, one day, if they are less acquisitive or there just aren't as many big deals out there as they grow, then maybe it will be something where they do start to distribute some cash. I know that hasn't been something that Warren Buffett and Charlie Munger were ever into, but no, it's a great company, and everything that they own is producing and worth hanging on to.
Is there a theory behind why they don't pay a dividend?
I think part of it was from a tax perspective. I mean, if you bought Berkshire Hathaway, 40 years ago, you have paid $0 in, if you haven't sold it, and you haven't paid any dividend taxes or capital gains. So that's part of it. But also, they were great capital allocators. So what's the point in, paying a 5% dividend if what you're investing into along the way is producing a higher ROI. So that's how it got so big, is just buying good businesses and holding them forever. I mean, it's a good strategy.
All right, let's go to an email before we take a break. This is from Bill. He says, will the Harvest Healthcare Leaders, ETF, HHL, make a comeback this fall given Trump's proposed tariffs on pharmaceuticals? When or do you see any positive movement in pharmaceuticals occurring? I'm liking the questions today. They're very specific, but it's almost like, please look into your crystal ball and tell me exactly what's going to happen at this point. Pharmaceuticals and a lot of the healthcare space has taken a big hit this year. There's been a big downward slide and not a lot of interest from investors. When you look at that space, and then you can look at sort of this one in particular, what do you see? I mean,
I learned very early in this business, don't fight the Fed. I think this is along the same lines of, don't fight the president. I mean, he has taken direct aim at this whole sector. In many cases, from a citizen's perspective of the U.S., he's probably not wrong that Americans are paying too much for pharmaceuticals, and so he wants them to pay less, and that is going to be difficult for their businesses. So, the crystal ball time frame of this fall, I mean, I have no idea what's going to happen in the next little bit. We don't do a lot with ETFs. And part of that is because we don't often want to own the whole sector. So what I would probably do here is take a look at individual pharmaceutical companies and find the ones that you think will do well in the current environment, rather than just trying to make a big sector bet or, what is the president going to come up with next. So, yeah. Don't know what's going to happen in the next quarter, but if I were to make a bet on this, I would say, they're going to have a tough go.
Okay. When we come back, I want to talk about which metrics you look at and that sort of speak to you. We're also going to take a look at your past picks in a moment. We'll do that. Chris is sticking around. Stay tuned. Welcome back. It is time to have a look at the past picks for Chris. These are from February 11th of this year, February 11th, 2025. At the time, Chris, you picked Suncor on the TSX. It was 58.05, now down to 54.56, so a 6% drop return and a 4% total return drop. Energy itself has had sort of a volatile period, generally speaking. Is this a stock that you are going to hold for a longer period? Have you already dropped it? Where do you stand?
We like Suncor. It is not going to be a top pick today, but only because I wasn't allowed to do the same one again. So okay. We think it's a great business. I mean, these fully integrated oil names or energy names, where they've got everything from exploration to refining to you putting gas in your car. I mean, energy is not going away. Energy's not being consumed less. And I think that this is a great holding. They are buying back a lot of their stock. That's a bit of a theme that you'll hear about all three of these past picks, is that they are buying back their own stock in a big way. They're trading at low valuations. They make lots of money. I mean, this has all the trappings of a good stock. It just may be a bad period.
Are you shifting your energy priorities at all? I mean, some people are looking more down to natural gas, expecting a pickup sort of in the next year to 18 months. Other people are looking at uranium as the new one sort of down the road. Are you shifting at all at this point?
I think you want to own a basket of them. I mean, there's Canada, there's a few. One of the things that we are particularly good at is energy, and whether that's mining uranium or getting oil and natural gas out of the ground. I mean, these are all businesses that do well. And I mean, this stock hasn't gone up over this period. I mean, I think oil is down maybe $5 in that period, but they're still making lots of money. The business itself is performing, and I think over time, if the stock doesn't go up, then they'll just keep buying back more and more of their stock, and and that's across the space. You can own oil, natural gas, uranium, all of them.
Got it. Okay, let's get to your next pick from February, which is an interesting pick, which was General Motors on the New York Stock Exchange. It was at $46.70 US. It's up to $53.55, so a 15% return upside, total return matched there. And I'm wondering why you picked, do you remember why you picked General Motors? And I'm wondering, of course, because of all the tariff noise and real concern that the automotive sector was going to be very beaten down by tariffs.
Yeah, and it has been beaten down. The beauty of General Motors at that time and even today is that it trades at an incredibly low valuation. So they have taken an earnings hit. So now it trades at about 7.5 times earnings, whereas back then it was more like 4.5. They make like $8 a year. Per share. So at $53, this is still an incredibly cheap stock. Part of the premise behind this, and the same for the next pick, is that throughout the tariffs, there are going to be winners and losers. General Motors is an iconic American brand. It's headquartered in America. They manufacture cars all over the world, but the majority of what they sell in the U.S., they make in the U.S., or at least one of their close neighbors. So that's obviously a bit of a pain point within the Canada and U.S. relations, but, the Republicans were elected, and I'm not a political strategist. I think I said this last time when I was on, that they were elected because states like Michigan went from Democratic to Republican. So for those companies to then get beaten down by the government is not probably a very good long-term plan. And so, cheap stock, great business. And now, with a lot of these tariffs, people manufacturing from other brands from Europe, there's going to be at least a 15% tariff on their vehicles. So maybe it makes GM vehicles look that much more attractive.
Okay, so let's get to your next pick because I think your same premise applies here, which Cleveland-Cliffs, which is a manufacturing company. They work in metals. At the time, it was $11.30, but it's gone down to $10.34 US, so an 8% return drop, total return the same. You would think, and sort of dig into this with me, if they are producing steel, for example, and there's a 50% markup on Canadian steel into the American market, that they have they could produce more and fill that gap more cheaply. But what has actually happened in that environment?
So I guess the performance of this pick, we're going to chalk this up to a bit of a timing issue, because the day that I came on, I think the stock was up 20% the day before. So when I sent in my picks, it was more like $10, and just a few days ago, it was almost $12. So it is a volatile stock. There is no doubt about that. But from a business perspective, they are also fully integrated. So they've got everything from iron ore production to coking to actually producing a final product. They have operations in Canada and in the U.S. So for those U.S. operations, they have a big advantage over a lot of their international competitors. So steel coming from Asia, that has a 50% tariff. And these steel tariffs are real. This isn't theoretical. They are in place today. So they have a definite advantage. A lot of the products that they produce are for the automotive sector, which, more of that production is moving back to the U.S. So, again, I would have put this one in my top picks today if it wasn't in my top picks last time. So we are buyers. And the option prices on this are very high. So I think when I did come on last time, the stock was $11.30. I said, hey, sell an April $10 put for 40 cents. So that actually would have made money. And doing that same trade again here out a couple of months, if you want to have a bit of downside protection, that's a trade that we're recommending.
Got it. And it's at 10.66 today, just for people's information. Want to take a break. Be back with Chris, Thom, answering your question today on North American equities and options. We're back in just a moment. Welcome back. Let's go to the phone lines. Valentine is on the line from Burlington, Ontario, with a question. Valentine, what's your question?
Good afternoon. I would like to know your opinion regarding Tourmaline Oil and their...
Okay, thank you for the question. I'm not sure if it got a little bit cut off there, but Tourmaline Oil is what he's asking about.
We like it. Tourmaline is run by Michael Rose. So we like stocks that, have the founders who are major shareholders who are, involved in the company. We think that then their goals are perfectly aligned with other shareholders. So, he's run this company for a really long time. It's done very well. It's one that can be a bit deceptive for people who are income-oriented investors because it's got a lower dividend, but they do a lot of special dividends. So if you look at the history of their special dividends, they actually have paid quite a bit and returned a lot to shareholders. So it's one that I think is worth owning, and it will. It should just continue to do well as long as he's around, as far as I'm concerned.
Would you pick some more up at this point? It's 59.46 today. 47, and obviously it is at a lower point. Would you dip in a little bit more?
I think it's worth buying here. I mean, it's definitely traded over the last few years in a range kind of between, the mid 50s to mid 70s. So you're towards the lower end of that range, and I think that they'll just continue to make money.
Got it. Let's go to another phone call. Anne is on the line from Scarborough, Ontario. Hi, Anne.
Oh, good afternoon. Chris, could you please explain if the profits and revenues exceeded estimates for Cameco, why is the stock down $4? Oh, my goodness.
It doesn't always make sense. We know. Okay, thank you for the question. Cameco's got a lot going for it. We were talking a little bit about energy and uranium and the pickup on that in the coming years. As we heard from Ann, the stock may have taken a bit of a hit despite doing well. Sometimes things just work that way. But do you see any specific reason for that?
I mean, sometimes these things, the stock just gets a bit ahead of itself, and the market, thinks that it has too high of expectations. So that's probably what the case is here. I mean, nobody knows why there's more sellers than buyers today. But, I think this is a pretty mature business in the space, whereas, we tend to, on this one, focus a little bit more on some smaller companies earlier in their cycle, like NextGen. But yeah, Cameco is a great business, and if you've held it for a long time, you've done really well. Even on days like today, where the stock's down, you're probably up over the long run.
You wouldn't really worry about it.
No, I mean, for us, we tend to only make buy and sell decisions on, if something's changed with the business. So if it exceeds our valuation, then we'll look to sell, or if something has changed with the business. So if there's nothing in the report other than that they're making good money, and maybe people just thought they would do even better, then that's why you'll see some sellers. But no, a one-day move like this is not something that I would be too worried about.
Got it. Okay, let's go back to the phone lines then. William is on the line from Mississauga in Ontario with his question. Hi, William.
Yes, hello. Thank you for taking the call. My question is about writing a covered call. It chose my target for this phone call to be Toronto Dominion Bank. But I'd also like to ask the gentleman whether that would be a preference over Enbridge. Writing covered calls on, I've done it before, but I would like to know which of those two would be, for short-term covered calls, would be a better choice.
Okay, thank you for the question. Have you looked at both of those?
I didn't look at Enbridge just now, but we talked about BMO earlier. So TD has obviously had a great run. It's up like 32% year to date. I mean, they had some issues that led to the stock being lower. So, if it is something that you've held and it's reaching where you are comfortable selling it, then, you'll probably want to pick a strike that's a little bit close to where the stock is trading. So it's trading at about $101. If you go out to October and sell the 105 call, you're only going to get about 90 cents. So not a huge pair, but if you add that up, you look at October, that's 2.5 months away. So if you could do this 4 or 5 times in a year, that's really going to add to that overall yield. And if your worst case scenario is that the stock goes up and you have to sell it at an even higher price, then I wouldn't worry too much about that. The thing with Enbridge is the call premiums can often be weighed down by dividends. So if you are going to sell calls on something that has a higher dividend, and if it's a lower volatility name, you can expect that option premium to be kind of small. So it's interesting because, if you look at covered call ETFs, the ones that are the biggest that people kind of clamor over the most are the banks and utilities and pipelines. So the market obviously sees value in doing those. That's not something that we'll really do. If you've got something like Enbridge that's yielding whatever it is, 6 or 7%, that's a pretty good yield already. So to try to add another 1 or 2%, but maybe lose the stock at too low of a price, is something that we would maybe shy away from.
Got it. Let's go back to the phone lines. Frank's on the line. He's in Edmonton today. Hi, Frank.
Hi. I'd like Chris's opinion on Cenovus. They came out with their earnings today, and they were lower. The stock shot up and then dropped again. So I'm underwater by about 30%. Should I sell and move on, or buy more, or just wait?
Yeah, it's hard with the energy sector right now to figure out which way is up almost. What is your take on Cenovus?
We like it. I mean, same thing we were talking about Suncor earlier. Cenovus has been in the same boat. I think it's down even more than Suncor over that period. But these companies are making lots of money. So, one of the things where we usually start our research is PE, and so this is trading around 13, 14 times. A lot of these companies, Cenovus included, have huge share buyback programs. So I think their NCIB, their normal course issuer bid, as it's called, is to buy back something like 8% of their float this year. So, that puts a bit of a floor under the stock, and they can only do that if they are making money. So I think that a lot of these energy names is something that, for the time being, the market has gotten it wrong. So, you could look at selling a covered call on this to try to generate some premium. But with Cenovus, we're probably going to wait until it's maybe over 25 before we start to sell some calls rather than just, force ourselves into it here. That's one of the nice things about having the flexibility of when we sell options on particular positions. We're not using an ETF for that. So yeah, for now, I'd say hold it. And if you wanted some more, you had some cash, I think it'd be okay to add here.
Got it. Okay, we're going to take another quick break before we get to our last block of phone calls and emails. Chris is sticking around. He's taking our calls today on North American equities and options. Back in a moment. Welcome back to the show. Chris, we had talked a little bit about metrics, and I'm wondering which one or two appeal to you. Where do you start when you're looking at a stock to decide what you want to do?
So for us, the majority of the time we start at PE. We want companies that make money. We were talking about the success of Berkshire Hathaway, how they own a huge portfolio of companies that make money. I mean, that's our biggest thing. We're not really taking a lot of chances and speculating on, where something will get to. I mean, we talked about GM. I mean, that was the best of my top picks. They actually made less money now than they were making before, but the stock was so cheap that it's gone up. So that's definitely where we start. And then from there, you can run down the list of everything else to look at. For us, it's growth after that. I mean, we want to make sure, okay, this is where these companies are earning today, and will that continue? So we don't want to be buying things that are, have dwindling earnings that we think will carry on. So I mentioned GM. I mean, their earnings have gone down, but I don't think that is something that will persist.
Got it. Okay, let's go back to the phone line because Les has been holding on the line. He's in Vancouver. Hi, Les.
Hi. Yeah, I invested in Palantir about, I think 5 or 6 years ago, and it went down, but then it shot up. Is it a good time to sell or buy or hold? What's your opinion?
Okay, so Palantir up, I love that number, 503% over the last year. Do you think it's hit its top, or is there more growth for Palantir?
So, yeah, this is a name that we don't own, and I wish we owned all of it. They say there's two types of stocks, ones you should have bought more and ones you should have bought less. And so far, this has been one that should have bought more. So for us, I mean, I can't tell you that we're selling it here. I mean, the valuation has definitely expanded. I mean, the business is growing. If I'm going to go back to the same advice that somebody else had asked about whether they should trim is, you can take a look at selling a covered call on this. The thing with Palantir is, all that volatility has made the options very expensive. So even here at $159, you can look out to September and sell the $175 call for $8.15. So that is, 5% of the current share price, and you've got $15 of upside.
Yeah.
And that's out to September. This is to September 19th. We're talking, 50 days from now. Someone, your worst case is somebody buys either your whole position or part of it at a $15 increase from here. But you keep that $8 no matter what. If stock goes down, the $8 is yours. And if it goes up, your net sell price is going to be at $183. So if you are fortunate enough to have owned this for a long time, and you're thinking of trimming, I would just keep it simple and not try to time the day where you sell it, and just sell these calls and see what the market gives you.
Got it. Okay, let's go back to William on the line from London today. Hi, William.
Yes, hi. Good morning. Thanks for taking my call, or actually good afternoon. Anyway, I was going to call about CP Rail. It's down about 2% today at about $102. Wanted to ask about a cash-covered put for about $99 or $98. There are some issues about their earnings, so that's maybe why it's down today, and some concerns about tariffs on steel, etc., shipments. Anyway, give me your thoughts, and if you did do a covered put, how far out would you go? Thank you.
Thank you for the question. So when you pull up CP Kansas City, what are your thoughts?
So these rail companies, I mean, they're obviously not monopolies, but they're close, right? Yeah. There's only a few, and they're merging. We just saw that big merger yesterday happening with
Norfolk?
Yes. And, so there's less and less of them, right? I mean, this used to just be CP, and now it's CP Kansas City, right? Yeah. So, you're likely to see more consolidation. So this is probably this is the type of stock that just ends up in a portfolio and, you just hang on to it forever. They're not big dividend payers, but they are good capital allocators for the most part. So if you're looking to get some more of this stock than selling a cash covered put, you've got that money set aside. So that's what the cash covered piece of that means. If the stock goes down, you've got that money sitting and waiting to buy that stock. These being a lower volatility name, the options are not huge, but they're not bad. So if you were talking about 99, we can look out to November. So we're going a little bit further than some of these other trades that we discussed, and sell the $98 put for probably $265. Okay, so you're getting, call that almost 3% for that option. You're going out 3.5 months. It's something that you could maybe do a couple of times a year, but if the stock drops, now you're entering at about $7 net below where the stock is trading today. And I think that's a good trade for that piece of the portfolio. This is, we're always talking about diversification, right? If you're incorporating options into a portfolio, you don't want to just look at your screen and say, well, I'm going to sell options on all the most volatile names, because when the market goes against you, well, now it can do it in a big way on everything. So for that lower volatility piece, I think you can sell these puts, and if you acquire the stock, then you'll probably just hang on to it forever.
All right, we do have to leave this conversation there. We're back in a moment with new top picks from Chris. Stay tuned. Tomorrow on Market Call, Tony Sierra will be on the show, Vice President, Senior Portfolio Manager at Caldwell Securities. He'll take your questions on North American large caps. Thom is going to share his new top picks. His first one up is Lululemon, which has not been doing very well, but you obviously like it moving forward despite the competition. Why is that?
Yeah, so Lulu has moved into an area where we think it's good value. I mean, it's been under pressure. The stock's been a lot higher. It's trading, I think, at 202 currently. So at these levels, it is around 14 times earnings. So for us, we think that is a good value, where it is typically traded at a much higher valuation than its peers and the rest of the market. So it's an interesting one, because obviously it's based in Canada, but they get about 80% of their sales from the U.S. So that, with their manufacturing coming from overseas and tariffs and all that, that has put a lot of pressure on the stock. Another thing that's put pressure on them is they've been a bit of a victim of their own success, where they, started out, it was mostly just, one product line for women, and now they've got athleisure and menswear and all these different things. So they've actually outgrown a lot of their stores. So at this level, we think it's good value. We always put an option spin on these things. So the stock trading at 202, you can look out to September and sell the 195 put and get about $11. Okay, so that gives you $7 of downside protection before hitting that strike. And then if the stock continues to drop, you buy it there minus the $11 that you collect. So if the stock does not drop, you're going to make close to 6% over a month and a half. They report early September, but if it does drop, then you're going to own something I think you can do well with over the long run.
Got it. Okay, let's get to your next topic, which is tech resources on the TSX. What do you like about tech?
So tech, again, I mean, it's a great business. They've really cleaned up their balance sheet in a big way with selling of their coal division. So now it's basically, pure play copper, if you want to call it that. And copper is obviously in the news. I mean, the two things that have really hit the stock over the last week or so have been, one, this mine expansion near Kamloops, which they're spending $2.4 billion. But that's going to extend the life of that mine until 2046. So longer term, that's going to be a good thing for the business. Trades at a pretty low valuation. And I mentioned how the balance sheet's been cleaned up. They've got like $4.8 billion in cash, which they are returning a ton of that to shareholders. So they've already spent, I think, $2 billion in the last 12 months buying back their own stock, and their NCIB has room for another $1 billion of buyback. So for us, we're looking at the $42 put out to September. For that, you collect, I think, what did I put here, $1, so 2.5%. give yourself a bit of downside protection. And yeah, we actually wish that tech would incorporate put selling into their NCIB. So.
Got it. All right, I want to get to your last pick before we run out of time, and that is CNQ, so Canadian Natural Resources. A lot of people love the stock, and it's actually down, though. I've got it at $44 today from earlier highs of about 50, 51, but you like it moving forward.
Again, we've talked about Suncor, we've talked about Cenovus. CNQ is in the same boat. You asked earlier as well about, oil or natural gas. They're about 70% oil, 30% natural gas. So you are getting a bit of diversification in there. But again, trades at around 12 times earnings. They're buying back a lot of their stock. We think it's good value and will continue to grow and is a good buy here. Do
you worry about the price of oil?
Not really. I mean, I think that, unless there's a big recession that actually reduces demand, I don't see oil getting too far below $60, and they make money there. A lot of these U.S. producers where Trump saying, hey, drill, baby, drill, they just can't really make money much below 60. So that puts a bit of a floor in there. And now if they're exporting all of this energy to Europe, $250 billion a year, I mean, that will be a benefit for any North American energy producer. So, I like it, and I'm not too worried about the price of oil.
All right, Chris, thank you very much for coming in today. Appreciate seeing you. And thank you for watching Market Call. Tune in again tomorrow. A quick look at the markets here as we head to a break.